JJ the CPA here. We're going to talk about credit card and the year-end aspects of that and how to make sure that you're getting the deductions that you need and deserve and that you're paying attention to the details. Do not tune out on this one. Do not think that you've got it figured out, because you don't. There are some finite things that you want to focus in on when you get to year end and you're using your credit card. The first thing to take note of is that when you charge your credit card, that is when you get the deduction. It is not when you pay it off. Let me repeat that another way. When you walk into the store and you swipe your card, that is when you're going to get the tax deduction. Just the same as when you walk in and you write a check or you were to hand them some cash. You get the deduction at the time that you charge it. The reason for that is that you now owe that credit card company. You don't owe the vendor anymore. So when you then go pay the credit card company, that is not when you get the deduction. So the other thing to note is that when you pay off a credit card, given that that's not a tax deduction, it does not help you to write a big check to your credit card company at year end thinking that you just did one wallop of a tax deduction. You did not. Now, when you're using a credit card, many times, especially if you get in the last days of the year, especially the last day of the year, 12/31, you could be in a circumstance where it does not show up on your credit card statement until the following year. That's not a big deal as long as you have the receipt and the receipt shows a date of 12/31, then you're in a circumstance where that is the year that you get to deduct it. The receipt is so key when it comes to this because that substantiates the deduction that you're taking, which pay attention to this one because so many of my clients, even the ones that have been with me a long time, seem to forget this each and every year. A credit card statement is not substantiation, it is not documentation that proves the tax deduction. Let me state that another way. If you don't have the receipt, you're not going to get the tax deduction. The IRS agent will not be able to prove, or you will not be able to prove to the IRS agent when you made the deduction and what that deduction detail was for. Think of when you look at a credit card statement, it only lists one thing, the vendor name, and a lot of times it may not even describe the store, or it will be unknown because it might just be some letters. It also is clear when you have a receipt what it is that you bought that you're not going to find on the statement. So even though I just said you don't need the statement for documentation, you do want it because when you go to record it in your accounting system, typically QuickBooks, you want to be able to show that you paid all of the expenses for your business from your business to that credit card. And with that being said, you do want to be able to take that credit card and enter that information into your accounting system because that is how you're going to ensure the deduction as well to put it into your financial statements, into your P&L. Now, with that being said, many times you are going to get a credit card statement and the cutoff date is not 12/31. And what do I mean by that? You get a credit card statement and it shows activity, let's say in this instance, from November 20th all the way to December 19th. So if you only were to enter in your credit card and to show that here are the dates and here are what I had spent from November to December, and you're putting that into your accounting system, your QuickBooks, and then when you get into January, you enter in those charges and you're entering them in as January, you just missed in this example any expenses that you paid from December 20th to 12/31. Why is that key? Because you only get the tax deduction if you've put it into your accounting system in the current year. So even though you're not going to get that statement till January, what you want to ensure is that when you're recording those expenses on your credit card statement, even though it's dated on a credit card statement in January, so December 20th to January 19th, be sure that you are splitting out and recording those entries properly and in the right year. And with a lot of our clients, when they just enter in their credit card statements once a month, what we would tell them is enter in that January credit card statement that includes December activity in 2 different transactions, or better yet, record each and every transaction in its current year. Now, other thing to ensure that this is done properly is that when you pay your January credit card, many will then use that check to then break out their expenses. Let me rephrase that another way. You pay your credit card on January 28th for a statement of activity from December 20th to January 19th. Stay with me. You're writing that check on January 28th, and many clients will then take that check and they'll do a detail of what all those expenses are. If that's how you're doing it, again, you only picked up those expenses in January. You missed all the ones that were in December. So what we want to look at is, if you're doing that, write 2 checks so that one of the checks that you're writing encompasses all the activity that you had in January, and then separately in December. So some clients, we will have them actually cut 2 checks so that they have that detail broken out. Here's the key. There's nothing you can do if you're sitting with your CPA in February or March or April and you're saying, well, what else is it that I can do? Nothing. There is really nothing that you can do other than something related to an IRA or an SEP plan, which is both related to retirement, or doing a match in your 401k or your simple plan, which again is related to retirement, or an HSA or a 529, but that's down at the individual level, meaning you have to do all of this by 12/31, and if you don't, you do not get the deduction. So why is the credit card key? If you don't have enough money in the bank and you need to prepay a bunch of expenses because you're trying to reduce down your income or reduce down your net income, your taxable income in the current year, a great way to do that is to use your credit card or to use your line of credit. And if you're doing that, then you can use those dollars as a deduction. So when you're getting into year-end planning, the credit card can be a key component to pull as many expenses as you can into the current year. But what we want to remember is, credit card, the statement is not documentation or substantiation. You need the receipt. The other aspect is you get to write it off when you charge it, not when you pay it. All right, hey, let's focus in. Get ready for the next video, because we're going to continue the discussion on year-end tax planning that's going to save you hundreds of thousands of dollars, because what you're learning now, you're going to be able to save each and every year end for the rest of the time that you are in business. So if we save you $5,000 this year, it may save you $50,000 over the next 10 years or $100,000 over the next 20 years. So tune in, get to the next video, because we are going to find more ways to save you dollars. All right, hey, thanks for tuning in, and then don't you forget, you've never met a CPA quite like me. Don't you ever forget, you've never met a CPA quite like me.